Welcome to Chapter 17 for AP Economics Structured Independent Study. Chapter 17 is all about taxes at the federal, state, and local level and what the government uses your tax dollars for. The first thing that we're going to do in this chapter is take a general look at taxes. In other words, what are they? We're going to look at where the power to tax comes from, the types of taxes that exist, some general characteristics about taxes, and then we're going to look at the burdens of taxes, and then what the taxes are supposedly used for. And then we're going to get into specifically taking a look at federal taxes. And the first thing we'll do is look at the specific types of federal taxes that exist. We will take a look at how individual and corporate or business taxes are paid, and we'll obtain an understanding of the purpose of Social Security, Medicare, and unemployment taxes. And while we're looking at the federal government, we'll also look at the other side of the coin, which is federal spending. In other words, what's done with the tax dollars that are collected. And in doing so, we'll look at the difference between mandatory and discretionary spending. Mandatory spending is spending that's required by law, that's put in place by Congress. Discretionary spending is spending that's done at the desire of the executive branch and can change and is not specifically tied to a law. We'll also look at entitlement programs, which are very tightly tied to this concept of mandatory spending. And then we'll look at federal aid to state and local programs. This is the concept where federal tax dollars are actually distributed to states and local governments for specific purposes. On the state and local side, we'll look at both taxes and spending as we did with the federal government. We'll focus in first on the importance of a budget to both the state and local governments. It takes on a different level of importance than the federal budget. We'll look at the major sources of state tax revenue, how the state taxes are spent generally, and we'll also do that at a local level. Let's start our general overview section of this chapter where we're looking at tax concepts at a high level, and start with a simple definition for what taxes are. And what I like to say is that taxes must really be important because throughout history many wars have been fought over them, and they actually even collect taxes from you when you're dead. Now that may come as a surprise to you, but there is such a thing as a death tax. But here's our working definition for taxes. It's a required payment to a local, state, or national government. And here's a question I've heard asked thousands of times. Why do we have taxes? Well, we have taxes to give the government the revenue or money it needs to operate and to carry out certain functions. So then I've heard this question asked many times too. Well, who gives the government the right to do this? Well, it's very fundamental in our Constitution. Article 1, Section 8, Clause 1 of the United States Constitution reads, "To lay and collect taxes, duties, imposts, and excises, to pay the debts, and provide for the common defense and general welfare of the United States. But all duties, imposts, and excises shall be uniform throughout the United States." Now, in this clause that I've lifted from the Constitution and read to you here, I have highlighted in blue a couple of key phrases: common defense and general welfare, and also uniform, that the taxes need to be uniform throughout the United States. And the reason I've highlighted those is that ever since, or even before the country was established, during the early stages of the country, today, and will be in the future, the whole concept over taxes and how they're dreamed up, administered, collected, and so forth always has been and always will be a subject of philosophical debate by our citizens in our society. And these philosophical debates usually come down over some of these areas which I've highlighted here, and how common defense, general, and particularly general welfare, is interpreted, and whether taxes are being uniformly administered across the country. But that's a discussion for other times. On the other side of the coin, here are some 5 limits on the power to tax. The first is that taxation must only be for the common defense and general welfare, as I had mentioned a few moments ago. No taxation for individual interests is not permitted. And quite frankly, that's one of the topical areas that leads to some of the debates that over time that I referenced a few minutes ago. Secondly, a limit is that taxes must be uniform across every state. Third, taxes cannot be imposed on churches, and this relates to the First Amendment freedom of religion. Fourth, it provides also for taxes cannot be placed on exports. And with regard to the specifics of how the income tax was to be handled, was outlined in the 16th Amendment to the Constitution. Taxes will fall into one of 3 classifications. I will explain the 3 classifications to you here, and in doing so, I will also give you an example of a tax that fits into that classification. Please make sure that you make a note of that example. Here's the first classification. It's called a proportional tax. This is a tax in which the percentage of your income that you pay in taxes remains the same for all income levels. In other words, if you were earning $50,000 a year and somebody else is earning $1 million a year, whatever the proportional tax on a particular item that you're paying will be the same regardless of your income level. And the best example of a proportional tax is a sales tax. Most states have a sales tax on many goods and services, not on all goods and services, but on an awful lot of goods and services. So if you were purchasing a good in a state where there's a sales tax and you were earning $50,000 a year, what you would pay in terms of the sales tax to purchase the particular good or service would be the same tax amount that the person earning $1 million a year would pay. The tax is based upon the item purchased, and it's the same amount. The second type of classification is a progressive tax. In this case, the percentage of your income that you pay in the tax increases as your income increases. And the classic example of a progressive tax is the United States federal income tax. The more money you earn, the more you'll pay in taxes. The third type or classification of tax is called a regressive tax. In this case, the percentage of your income that you pay in this tax decreases as your income increases. And a classic example of a regressive tax is the Social Security tax, in which case there is an income limit that changes periodically. That's changed by the Congress of the United States, but at a certain income level, you actually stop paying into the Social Security fund. So if you are below that income level for your income for the year, you will pay into the fund for the entire year that you're earning your income. If somebody else earns income beyond what the cap is for the Social Security tax, once they reach that cap amount in terms of their income, they will stop actually paying into the system. So Social Security is an example of a regressive tax. Next, we'll take a look at the characteristics of taxes, and particularly of a good tax. And I know a lot of people would say there's no good tax, but again, that's a debate, philosophical debate for, another forum and time. But there are generally 4 characteristics that are considered characteristics of a good tax. And here's the first: simplicity. Tax laws should be easy to understand, meaning they should be easy to keep records for, prepare forms if needed, and to pay on time. Second characteristic would be efficiency. Taxes, or a good tax, should be easy to pay and cost-effective to collect. Third characteristic would be certainty. It should be clear to the taxpayers when the tax is due, how much is due, and how it should be paid, and what the penalty would be for not paying the tax. And the next characteristic is very, very important, and that is the characteristic of equity. The tax should be fair so that no one bears too much or too little of the burden of the tax. Also, a good tax will generate, or should generate, just enough revenue that citizens' needs are met, but not so much that the tax discourages production, which will hamper economic growth. And speaking of fairness, how is it determined? Well, there are 2 ways that are used to determine fairness. The first is through the benefits received principle. This states that a person should pay taxes based upon the level of benefits he or she expects to receive. An example of a tax that the benefits received principle is applied to is the proportional gasoline tax. The second way to determine fairness is the concept of the ability to pay principle. Really self-explanatory, and the example to use here is the progressive income tax. If you earn more, you should be able to pay more in principle. You may recall a few moments ago when I was talking about the characteristics of a good tax, and I got to the characteristic of equity. I also referred to the concept of the burden of a tax. And that quite often leads to another question here as to who really carries the burden of a tax. And the best way to illustrate this in terms of the concept of the burden is to think about the sales tax. And in that case, in particular, it all depends on demand. And let me illustrate. If demand for a good or service is inelastic, and think again here sales tax, then the seller or producer will shift the burden of the tax completely onto the consumer. Again, a good example is the tax with gasoline. That gasoline is such an integral part of our lives for so many reasons that the gasoline tax is not borne by or carried by the producer or seller. When it's raised, it's moved directly onto the consumer in terms of the price per gallon. The other side of the coin here is that if demand for a good or service that there's a sales tax on, using this example, is elastic, then we have price sensitivities here, and the seller is more inclined, seller/producer, more inclined to bear some of the burden of the tax. Now, here are some fundamental tax terms that you need to be familiar with, and they particularly relate to the income tax side of things. The first is the concept of tax base. The tax base is the income, property, good, or service that is subject to a tax. Next term is tax return. This is the actual form that's used to file your income taxes, either personally or as a business. Taxable income. This is your personal or business gross income minus the exemptions and deductions that are permitted by law. And gross income is the salaries, wages, tips, commissions, interest, and income from investments, such as dividends. And speaking of exemptions and deductions, personal exemptions, and these are set or allowed and defined by law, are set amounts that you can subtract from your gross income. Some relate to yourself, your spouse, and also some relate to your dependents. And deductions are variable amounts set by law that you can subtract from your gross income. Such things as mortgage interest to a degree, donations to charities, some medical expenses apply in this case too, as well as local taxes can be deducted out. The last term you need to be familiar with is the concept of withholding. This is the practice of taking tax payments out of your pay before you receive it. And it's based upon your projected tax liability, in other words, what you will owe the government for a year. Your employer, if you work for a firm or somebody else, will wind up setting this up for you. But if you're working on your own as a sole proprietor, you'll want to make sure that you need to spend some time in figuring out what to withhold on a monthly basis so that you don't wind up with a big tax bill at the end of the year and be searching around for money to pay it. Let's now take a look at the 10 types of taxes. Here's the first, income tax. It's based upon a person's or a corporation's income. Second, sales tax, which I have used a couple of times as an example and illustration. It's a tax on the dollar value of a good or service being sold. Property tax, a specific tax on the value of a property. Next, excise taxes. Now these are special taxes either on the sale, so over and above a sales tax, or just the production of certain types of goods. We have excise taxes on gasoline, alcoholic beverages, tobacco. And the alcohol and tobacco excise taxes are very commonly referred to in our society as sin taxes, that they're trying to discourage the production or consumption of those particular items. And we even have excise taxes on telecommunication services. Just take a look at your cellular phone bill and you'll see them clearly laid out there. The next type of tax is what I had mentioned earlier on in this chapter. Many people refer to this as the death tax. It's the estate tax. This is a tax on the total value of the money and property of a person who has died. But it doesn't kick in until that value reaches $600,000 and above. But just it's interesting the fact that there is a tax like this on your death, if you will, is always just tickles me in certain ways. Okay, the next type of tax is called a gift tax, and this is a tax on the value of money or property that a living person, in this case, gives to another person, and there are some rules around this, which I'll cover here in a moment. The rules on the gift tax are rather lengthy and complex, so let me suffice it to say that they were created to close the loopholes that exist in the estate tax system. So we have a close relationship here between gift taxes and estate taxes. One thing I can tell you for certain is that you can give gifts in up to $10,000 in value a year tax-free. So as long as you keep it under that, you should be good to go. The next tax I'd like to talk about is the import tax or tariffs. These are taxes on imported goods, and they really only have one purpose. They're really designed to or created to protect certain industries. And the bottom line is that they're not really smart, as every tariff that has ever been put in place winds up retarding economic growth. The eighth tax that I'd like to talk about is the Social Security tax. known as the Old Age Survivors and Disability Insurance Tax. And this tax was set up under the Federal Insurance Contribution Act. If you look on a pay stub that you would get when you are working and you get paid, it will be listed as the FICA tax that is taken out of your paycheck, FICA, and that relates to the act that it was created under, the Federal Insurance Contribution Act. A couple of things about Social Security tax. It was set up in 1935 to ease some of the hardships of the Great Depression, especially for the senior citizen portion of our population. And it was originally just a retirement fund, but today it now provides benefits to surviving family members. In the event that you pass away before you reach retirement age, and let's say that you have a family, a wife, or a husband and children that need to be taken care of, there's an allocation that comes out of Social Security to benefit the family members and to provide some income backup, and also for the disabled. Now, earlier in this chapter, I had mentioned that Social Security is a regressive tax, and that's because there is a income cap that is set, and Congress periodically changes this. And what this means is that they will take Social Security tax, FICA tax, out of your paycheck up to a certain income level. And then after that, there's no further Social Security tax taken out. The ninth type of tax I want to mention is the Medicare tax. And what Medicare is the National Health Insurance Program that helps pay for people's health care who are over 65 and for the disabled. Now, unlike Social Security, there is no income cap on this tax. So however much you make a year, there will be continually Medicare insurance tax taken out of that, or ceiling of any sort on this tax. And the 10th type of tax I want to mention is unemployment tax, or what they call unemployment insurance. That's also taken out of your payroll on a pay period basis. And an important point about unemployment insurance taxes is that your employer also pays into that fund as well. So there's an overview of 10 types of taxes, and we're going to look at some tax facts before we move on to taking a look at what the government does with its taxes that it takes in from the spending side. So here's a couple of tax facts that I think you'll find interesting, and it will also help set up our conversation here on what the government does with the tax money it brings in from a spending standpoint. First thing you should know is that the federal government takes in roughly $2 trillion in taxes per year, and that breaks out to roughly or approximately $6,600 per person. And approximately 47% of the federal government's revenues, or taxes it takes in, comes from individual income taxes. So the income tax plays a really big role in funding the government. And the federal government spends almost $200 million every hour, which translates into $4.8 billion every day, and now well over $3 trillion every year. And now let's take a look at how the government uses tax revenues, or in other words, the money that they take in. And government spending really falls into two conceptual categories. Here's the first. It's called mandatory type spending. And by mandatory spending, we're talking about money spent on programs or to make interest payments on the national debt from the federal government standpoint that is required by law. The reason we use the word mandatory is because this type of spending is required by law. Now, the programs that side of this, of the mandatory spending, as opposed to making interest payments on the national debt, have had certain types of labels attached to them, which I've highlighted here. Some are called entitlement programs, and others are referenced to as just simple transfer payments. And let me give you a little bit of background as to why the mandatory spending programs are titled entitlement programs. Because this spending is required by law, the recipients of the spending, of the federal spending, have come to look at this type of spending as an entitlement, that where the government is required to provide this to the recipients of the program. The second thing that to consider is that a lot of people call these transfer payments because a lot of this is just taking tax dollars from people from the labor force and moving the mandatory spending to other people, and the types of programs that the money goes into does not really promote capital deepening and economic growth. Now, there are three characteristics to mandatory or entitlement programs. Here's the first. So they're primarily social welfare programs like Social Security and Medicare. Medicaid at the state level and also the food stamp program falls into this characteristic as well. Second characteristic of entitlement programs and mandatory spending programs is that once they're started, they're almost impossible to repeal and difficult to control the costs as things change in our society and our economy. The third characteristic is that there are a number of these programs that are means tested as a way to control costs, and that is a good thing. The second concept in spending, or for that matter, you could say the second type of spending, is called discretionary spending. This is spending about which government planners, particularly the executive branch of the government, can make choices about. The Congress does play a role in this as well, and there are three major categories of discretionary spending. Here's the first. With regard to national defense and the defense budget, approximately 16 to 20% of the federal budget goes towards national defense. Also, what falls into the discretionary category are the salaries, meaning what gets paid to the civilian branches of the government, like the Treasury Department, the State Department, and all the other functions of the government. That's the civilian portion, as well as the Congress, the senators and the congressmen and their staffs. The third category of discretionary spending is the aid that the federal government provides to state and local governments for specific items like building interstate highways or some state highways, roads, mass transit systems, and the like. And outside of the three categories that I just covered with regard to discretionary spending, here are some other examples of discretionary spending, which I'm sure makes sense to you, and you've probably heard about spending that occurs in a number of these areas. Now let's take a look at taxes and government spending from the state and local government level. And the states and the local governments are required to operate a little bit differently on the budgeting and government spending side than the federal government is. Tax revenues are pretty much the same, but it's the spending and budgeting side that's different. And there are three requirements that are placed on states and local governments on that budgeting and spending side. The first is that they're required to have operating budgets. that money comes into from tax revenues that pays for the state's day-to-day expenses. But they also have what's called capital budgets. And the money that goes into capital budgets pays for major capital projects such as roads, buildings, bridges, etc. And there's two sources of funds coming into the capital budget. There may be some general tax revenues, like, for example, if there's a state or a city sales tax, but also money comes into the capital budget from the sale of bonds, like municipal bonds. But it's the third requirement that really separates the state and local governments from the federal government. State and local governments are required to have balanced budgets, and that's actually put into law, that they're required to have spending match revenue for their operating budgets. Now, let's take a look at where state and local governments get their tax revenue from, the sources. Well, similar to the federal government, state governments and even some cities, municipalities, have personal and business income tax laws on the books. They also quite frequently have licensing fees or licensing taxes that they collect revenue from. For example, a contractor's license fee that they charge, but also your division of motor vehicles for car registrations, people's automotive license, and the like fall into that category as well as a source of revenue. Many states have something that's called transfer taxes. I like to call these sales taxes of another name, on such things as stock transfers and the transfer of real estate. They also have severance taxes, and these are very interesting, especially in the western states where we have so much of our natural resources. There's actually a tax on the removal of natural resources from the land. There are also classic sales taxes and property taxes that are levied by the states and many municipalities. Property taxes on land, buildings, and personal items. And just as we did with the federal government, we'll take a look here at three limitations on state and local taxation. And this is going to read somewhat similar in many ways to what the federal government's limitations are. First, state and local governments cannot put any taxes on imports or exports, as this is a national or federal responsibility. Second, the state and local governments can't tax the federal government on federal property. And similar to the federal government, state and local governments cannot put taxes on nonprofit, religious, and charity organizations. Let's now take a look at how state governments use their tax revenue. And there are 6 categories of spending. The first is on education, and it makes up the largest percentage of spending by the state governments. Next, public safety, which includes everything from state police, also in some states the firefighting, correction systems, and the like. Third, on highways and transportation. Fourth, on public welfare, including public hospitals and also environmental regulation and administration. And the administration of state government itself, in terms of the Senate and the assemblies, the court systems, and particular state departments and agencies. And the last category of spending comes into things such as arts, recreation, that includes everything from museums and parks within a given state or municipality. As we start wrapping up this chapter on taxation, I want to introduce you to an advanced concept in the use of taxation. And I'm going to give you an example of how taxation might be used to try to solve a social or societal problem or a problem within our economy. And what'll be interesting about this is you'll see that it ties together a number of the concepts we've learned in a number of the chapters prior to this one. So let's take a look. In our example, we're going to use taxes to try to solve a public policy issue. In particular, pollution causing a negative externality. So here's what we have. Assume that we have a situation where product X is produced in a perfectly competitive industry, and that product yields costs in the form of pollution to individuals who are neither consumers nor producers of the product. What we have here is a classic case of a negative externality. But can we use taxes to solve this problem? Well, in part one, in trying to solve this, what we need to do is use a correctly labeled graph that shows the industry output and price under each of the following conditions. Now, at the outset, that sounds like a supply and demand graph, and it's not, but it's very close to that. So here's one of the concepts that we can take and leverage, meaning the supply and demand concept, and leverage to solve and illustrate an answer to this problem. The first condition that we want to illustrate with our graph is the condition that currently exists. The industry is ignoring the externality and it's polluting at will. So what does that look like from a graphical standpoint? Then we also want to show the second condition, which is the condition in which the industry would produce what we call the socially optimum level of output. In other words, what we would like to see the solution be. Now, in doing this, we then move to identify and also graphically illustrate one policy the government might use to achieve the level of output which is socially optimum that we desire. So here's what a graph would look like. Looks very similar to our classic supply and demand graph, with the exception that we're taking the label on the y-axis from price to benefits and costs, which are quite frankly very closely associated with price, and measure those on that axis. So here's what we have. When a firm ignores the externality, in other words, we're illustrating condition A from the previous slide. When the firm ignores the externality, the firm produces where what we call the MPC, or the marginal private costs, are equal to the demand for their product or service, the marginal social benefits. And, however, since there are added costs, meaning the pollution on the society, and this is where we begin to illustrate B, what we would desire. There are added costs, the pollution placed on the public. These additional costs must be added to the private costs to give us what we optimally want, which is the MSC, the marginal social costs. And as a result of that, we would then be able to see what the socially optimal level of output should be. In other words, a cutback of the production to save on the pollution. But what we have here is that the demand in the market is going to rule here unless the government does something to reduce the marginal social costs. And this is where we're going to propose some government action, maybe through taxation, that can reduce the marginal social costs. And until that happens, the society is going to have to carry what we call the burden of the pollution, which is what we call dead weight costs that are illustrated here by the green shaded area on the graph. So how can we get to the optimum level of output and eliminate the dead weight costs that we've illustrated here? Well, we started this example about talking about how to use taxation possibly to eliminate the negative externality that we see. And a tax could be put in place by the state or the federal government that is not an income tax, could be an excise tax, or maybe even some kind of severance tax if that particularly applies here, to raise the cost of doing business for the producers and throttle them back a little bit so that they reduce output and get us closer to the optimum levels and reducing the pollution that we would like. Now, there are actually a couple of other ways, two other ways besides an actual tax that can have the same effect and get us to where we need to be. And I know I've used this example of saying we're going to use taxation to do this, and you could see here how that's done. But also a consideration might be a quantity restriction placed on producers in this particular industry in terms of an output quantity restriction to reduce the pollution, or to put in a system of pollution permits that might even be tradable among the producers. So there are a couple of other ways besides a tax that could be used potentially to get rid of the negative externality or certainly lessen the effects of it. And that brings us to an end of chapter 17. We'll look forward to seeing you in chapter 18, which is the chapter on fiscal policy. A very important chapter. As a matter of fact, we've got two really important chapters coming up: fiscal policy and monetary policy. So we'll see you there.